Hi, my name's Anthony with Emerald Sun Energy. And in today's video, we're actually going to do a case study on a new way to structure commercial solar deals that I think is going to revolutionize not only the ability to incorporate solar, but to do it in a way that is just so financially beneficial, it's going to be hard to look elsewhere. This is a new financing mechanism that is really come available in the last 9 months. And what I can tell you is from not only the recommendations, but the feedback that I've had from prospects and people that have moved forward with this, that they're choosing this option. And for good reason. Um, the first thing that I'll do is just briefly go over before we jump into the case study is go over the current deal structures that are actually available and how you can and how they've been incorporated and what kind of makes this option not only more feasible, but again, more financially beneficial, especially in the short term. Like the beautiful thing with going solar, especially on the commercial side, you're looking at long-term savings that are really impressive. Like in this particular option we're going to look at, their long-term savings is over $6 million over what they're going to spend otherwise. They're spending this money and they're going to continue to spend it. Um, but by incorporating the right method, they're going to be able to save that amount of money. One of the hurdles that solar kind of comes up against on the commercial side is that that $6 million is going to be in savings. So what that means is once they fix rate that energy bill or fix rate that expense, they're never going to really tangibly feel that return on investment. Yeah, it's great, and it'll actually impact and help the business, help control costs, and do a lot of amazing things. But in terms of, for lack of a better word, a sexiness to the deal, where in that deal of $6 million, you're going to see we have an opportunity for them to cash out within 18 months with no money down, no money out of pocket, in the neighborhood of $1.4 million that they can realize in real profit, hard cash earnings. And for any business owner who's looking at creating wealth and creating revenue, that's obviously just an enormous opportunity and ability to do that. And this strategy is specifically tailored towards commercial properties, but also real estate investors, especially if there's any kind of power control already involved. If not, we'll actually even discuss how you could, I guess, take control of that. But in terms of these cash out options on a property with no money down, no money out of pocket, to be able to pull significant revenue out within 18 months it's really amazing. But currently, not many people know about this, not only because it's new, but once there's a certain way of doing things, people continue to do it, even oftentimes when a better way has presented itself. Like right now, the main ways people are purchasing solar on a commercial or real estate investor level is through obviously a cash purchase. And then you'll hear terms such as payback period, because you're going to factor in your tax credits, you're going to factor in your depreciation. And in the end, you'll have, between a 4.5 to 5.5 year payback period for a system that's going to produce for 25 years. It's a great investment. But again, in terms of that curb appeal of sexiness, it lacks that teeth and that real interest to drive people to move forward on these opportunities, even though there's great long-term savings when you're able to combine an amazing short-term return, still hitching yourself to a very strong long-term return. Now I really think we have something that's going to take it to the next level. On top of that, there's traditional financing, which puts you into a 7 to 10 year term. And typically for those 7 to 10 year terms to make sense, you're going to be upside down, meaning you're going to spend more than you're currently spending on your energy expense to fund the deal. Now, again, long term, those savings are there. But in the short term, you're absolutely actually upside down. And again, your conversation has to be about payback period. Um, what we're going to be able to do in this case study is flip that narrative and flip that script and talk about cash flowing day one. So it means no money down, no money out of pocket. Use the money you're already paying the power company to convert not only an expense into an asset, but to cash flow day one, meaning you're going to be making money. So it's not about payback or pay back period anymore. It's about cash flowing and then how much money can you actually profit from this in hard cash, especially in the short term, before it gets lost into that saving mechanism, which is still, again, valuable and awesome. Um, so we're going to go ahead and take a look at our options here. So here we go. So this is an actual example of a deal that we've done out in Ronkonkoma and in New York, but currently we're in Florida, Pennsylvania, New York, New Jersey, as well as Arizona, New Mexico, North Carolina, Georgia. We're in many places. If there is an interest in any of this, obviously just reach out, and if it's something we can't help you with, we have partners that understand this mechanism and will be able to help you. Um, as again, just a brief overview of also, what you're going to be able to do with solar when you bring it into either a commercial opportunity or a real estate investment is obviously reduce energy costs, increase energy independence, and really on the commercial side, it's improve that brand image. And you'll see a little bit later in this case study the brands that are spending the most money on solar. You'll recognize all of them. They're doing it for a very simple reason. It makes them money, and obviously you get to embrace environmental sustainability. So particularly in this case, what we did is we took a look at what they were using, their consumption, and the total annual kilowatt hours in this case was 1.5 million, and their average electric bill was $21,000 a month. And what we're going to really be able to show you is how to use that money that you're already spending so there's no effect to your bottom line, no effect to your budget. And that's where the no money down, no money out of pocket portion of the conversation kind of kicks in. But the first thing we want to do is just look at why that long-term viability is so strong. And it's because what the future projections without solar to your power bill are. And this is actually a tick lower than what the national average is over a 20-year running period. Um, it's 3.75 in this example. In real world examples, it's 4%. But like the last 2 years have been double digits. And with a lot of the shift in how energy is going to be produced and supplied, in many cases, this you may see parts where you're going to be in that double digit a lot longer. This is very conservative, but we like to do that so you can see not only what's realistic, but on the very low bottom side, this is the least amount that you're going to be paying for power. And it could be significantly more. So just in 5 years from now, that $21,800 is going to be 25,000 and change. 10 years, 30,000. Well, I'm going to run it down to the 25-year number because that's really how long the panels and systems are usually in a either warranty state or guaranteed state of production. So that same $21,800, just by increasing it at 3.75 a year, in 25 years, that payment's going to be $54,000. So the total amount paid to the power company is going to be over $10 million. So now in any of these structures, what we're really talking about is how much of this can you keep or save for yourself? And that's the main motivating reason why people are incorporating, especially on the commercial and real estate investing side. But as we go into it, we're going to show you how much of this you can actually get within an 18-month window. So again, in terms of the recommendation part, property value increase, energy expense decrease, government huge incentives with great long-term return on investments. So the panel system size that we're going with here is 1,000 kilowatt or 1 megawatt. And the beautiful part is you'll see here from the billing part, the amount of energy this system will produce is at $21,850, but they're only going to be paying $15,240 a month. That means they're going to save over $6,000 a month. So it's amazing. And this is actually considered an intro rate. You have the ability to keep the rate, and we'll talk about that again as we get a little deeper. But you get this rate no matter what your first 18 months. So the first 18 months, you're going to save a minimum of $6,000 a month. At month 19, you get an option. And in this particular structure, we're going to be talking about an option to take money out of the deal, put it in your pocket. Now, this rate then will adjust up, but you'll be pleasantly surprised what it adjusts to for the amount that you can cash out with. I'm going to skip because this is a case study. I'm not going to do a lot of why Emerald Sun Energy, but I'll pause here real quick and just highlight the major brands that have made significant investments into the solar arena. And again, for simple reasons, they're making a lot of money in net savings to do so. So you have your Walmart, your Target, your Disney, your Apple, again, all brands you've seen, know very well. So now when we take a deeper look at the financial analysis, the cost of this system to get that 20-year 4.99 rate, and let me explain what the difference of this rate is and what you're seeing on the traditional side. Like earlier, I mentioned you'd have a 7 to 10-year option. And in that 7 to 10-year option, that interest rate in the current state right now would be in excess of 8.5, probably 9, potentially even 9.5. So you're going to pay a much higher interest rate, and you're going to have a shorter term. So that monthly payment is going to be much higher, meaning even though the system's going to produce $21,000 a month, if you're financing it that way, you're probably going to be paying in the neighborhood of $30,000 a month, $35,000 a month. So it's really now just created an additional expense. Now, if the business is is very cash oriented and you want to displace some of that cash, those are definitely ways of doing it. And you don't mind increasing your budget. But to cash out, which you could still do, you're doing it with an increased expense budget, and those numbers just don't work as appealing and as easily. But in our option, what we're able to do is structure the deal in two ways. What we've done is it's called buying down the points and extending the term. And when you're able to find a financing mechanism that's able to do both, you're going to be able to flatten out that cost, possibly over a little bit longer period of time, but it's going to allow you to realize profit money in your pocket sooner, which I think changes the narrative, changes the conversation about when and why to go solar. So in this particular option, again, the system was $3.1 million. The 30% tax credit is $954,000. And there's actually another 10% that's going to be coming available. It's already available. We're just waiting on the details on how to make sure you can collect on it. And also you're going to be able, because now this is major equipment you own, you're going to be able to depreciate it, and depreciation ratio, again, these are conservative, is 445,000. So between those two, you have $1.4 million. Now, again, your first 18 months, you're going to pay $15,240 for a system that's going to produce $21,000 and change in energy, freeing up $6,000 a month. But in month 19, what you can do is take that $954,000, that tax credit, instead of paying down the principal, which is also an option. You could take that tax credit, pay down the principal, and you keep that current rate, that 15,240. So you could put in a long-term savings of that minimum of $6,000 a month. And keep in mind, every year that ratio, that saving percentage is going to go up by 4%, if not more. But you can take the tax credit, you can take the depreciation and actually pull it out in cash, no effect to your budget, no money down, no money out of pocket, using that $21,800 that you were spending on power. Now, all of a sudden, that rate is going to adjust up. It's going to adjust up to $20,991. So yes, that means you're still going to save, in this example, $800 a month over what you were spending, and you get to realize $1.4 million of that long-term return on investment within 18 months and in cash, where the rest of it's going to be in savings. Like I said, again, it's still super valuable, but you don't get to, it's not tangible. You don't get to have it. You just get to earmark it and then probably reallocate it through the growth and expansion of your business. So when we look at how this breaks down on the ROI, and it's a year by year breakdown, um, at the current rate of $21,800 a month, the annual, so we broke these down to annual numbers, the annual amount of your electric bills are 262,000. Like I said, no matter what, your first 18 months, you are going to get that $15,000 rate, which puts this at 182,000. So your first year, you're already going to cash flow 80 grand in savings. And that part you'll probably be able to actually feel a little bit. Midway through that second year, month 19, so you're going to get another 6 months of that $15,000 rate. And then it's going to adjust up to the 20,900 rate. And that total then will be 217,000. But you can see here now that 262 has also gone up to 271, because that's just based on that 3.75% rate increase that the power companies raise their rates every year. Now, in this example, you're taking the tax credit. So you're pulling out that $954,000, which makes your ROI over $1 million. And this is in actualized cash. And that's not factoring in that other 445,000 we're talking about that you can pull and take in depreciation as well, or again, redistribute into your business however you so choose. In this other example, and you could see that 182,800 is steady all the way through. Under this example, what that means is they took that 954,000, paid it against the principal, and maintained that rate. And then you'll see that the return on investment year over year is going to be more than in the other column, but you got to cash out in actual cash, where again, these are really going to be taken in savings. And long term, over time, you'll get to see the difference, where if you fix rate it and take it slowly over time, you'll actually make an additional $300,000 over 25 years. But in this option, which is the one that not only that that I'm recommending, and it's just because again you could actualize and it's a tangible return on investment within 18 months, no money down, no money out of pocket. That 300,000 spread out over 25 years. I won't say it won't necessarily go completely unnoticed, but to cash out $1 million, no money down, no money out of pocket, I think it does. And that's what you're able to do with this new structure, is again have the ability to realize tangible profit, tangible cash within the first 18 months. And ultimately, you're still cash flowing the entire way. Like you're never upside down on the deal, and you get to assume that that amount of liquidity in a short period of time. And you know that $300,000 difference, seriously, no joke. If you took the $1 million and just put it into money accounts, you would crush that 300,000. So this is absolutely the option to go. I just like to again be very transparent and show you the entire case study on how not only we presented it but how it was accepted, and yeah, so it really changes, you know, the evolution of what's really available on the commercial side. We've seen an enormous expansion already on the commercial side, and I think this is that last domino to fall where you're just going to see company after company really run this up the flagpole because it's just an amazing deal structure that's going to revolutionize commercial solar energy. So if you'd like, I'm going to add some additional links in the video here on the bottom that will talk more about the other deal structures in a little bit more detail into case studies. Because in all seriousness, sometimes some of the other deal structures are simply right for your situation. For example, you had an insane year, you're flush with cash, you know you're going to get hammered on your taxes. Why not make the big purchase and do the payback period? Because you're going to save yourself on the asset side or on the tax side, I should say, on the front side. So we'll go through some of those other examples, but also specifically on the commercial real estate investing. This is insane, guys. This is insane. All about real estate investing is about cash flowing. And now what you're going to be able to do is convert an expense into an asset and then pull those funds in cash and profit. And a lot of times you're not going to own the asset in 10 or 15 years. So you're able to cash out, again, 20% of the long-term savings in actual hard cash and then pass on that expense to the to the occupant, to the leasee, and just add that expense in to what you're doing and just cash out these, you know, again, this for a typical real estate investor who's going to lease the properties, this is an insanely big system, and you'll probably be looking at, you know, maybe 150 to $200,000 cash out instead on your deals. But again, it's free money, man. It's no money down, no money out of pocket, using money that's already earmarked for energy and just reallocating it so you can cash out a big chunk of it. Anyway, I hope this video was helpful. You could there's links to us in the description as well. If you do want more information, please either book a consultation or reach out to us directly. Thanks.